If you think silver miners are just underperforming because of bad management or weak metals prices, you're missing the real story. What if I told you their pain is intentional? What if the market needs them weak, invisible, and undervalued? And what if the moment that pressure breaks, everything reprices violently? For years, investors have been told the same tired explanation. Silver miners are risky, costs are rising, energy is expensive, labor is tight, grades are declining, so the stocks stay flat while everything else runs. But here's the problem. That explanation falls apart the moment you zoom out. Silver itself hasn't collapsed. Industrial demand is accelerating. Monetary demand is quietly building. And yet, the companies that pull silver out of the ground are being priced as if they're on the edge of extinction. That disconnect is not random. Markets don't misprice entire sectors for years by accident. Silver miners sit at the most uncomfortable intersection in global finance. They represent leverage to a monetary metal in a system drowning in debt. That alone makes them dangerous. Not volatile, dangerous. Because if silver prices rise sharply, miners don't just benefit. They expose structural weaknesses in the financial system. Rising silver prices signal inflation that can't be contained, currency debasement that's accelerating, and physical shortages that paper markets can't explain away. Suppressing the miners is one way to mute that signal. Look at how capital flows behave. Tech bleeds for a year and still trades at aggressive multiples. Unprofitable companies get endless second chances. Meanwhile, profitable silver miners with real cash flow struggle to attract institutional money. That's not because the math doesn't work. It's because the optics don't work. Big money doesn't want exposure to assets that question the credibility of fiat currencies or central bank narratives. Silver does exactly that. And miners amplify it. There's also a structural mechanism at play. Silver miners are tied to the futures market in a way most investors don't understand. When paper silver is aggressively sold to cap price moves, miners feel it instantly. Their revenue projections get marked down, their reserves get discounted, analysts lower price targets, sentiment collapses. This creates a feedback loop where weak silver pricing justifies weak miner valuations, even if the physical market tells a very different story. Suppression doesn't have to be a conspiracy whispered in dark rooms. It can simply be a series of incentives aligned in the same direction. Then there's cost pressure, which is real but selectively weaponized. Diesel prices rise, and suddenly miners are uninvestable. But when costs rise for tech companies, it's framed as a temporary margin issue. When banks face losses, it's called a one-off event. For miners, every challenge is treated as existential. That framing matters. Markets trade narratives more than numbers, especially in the short term. And the narrative around silver miners has been deliberately kept pessimistic. Another piece most people miss is geopolitical. Silver is no longer just a precious metal. It's a strategic industrial input. Solar panels, electric vehicles, military tech, medical equipment. Governments want access to silver without signaling scarcity. A rising silver price draws attention to supply constraints. Strong mining equities invite investment and expansion, which raises uncomfortable questions about why supply hasn't kept up with demand. Keeping miners suppressed keeps those questions quiet. History gives us clues. Every major bull market in precious metals began with miners being ignored, mocked, or outright hated. Gold miners in the early 2000s were dismissed as relics. Uranium miners before 2006 were considered dead money. The turn didn't come when the fundamentals improved. It came when the pressure became unsustainable. Silver miners today feel eerily similar. Low valuations, high skepticism, strong underlying demand that no one wants to talk about on financial television. And here's the most important part. Suppression works until it doesn't. It works as long as paper markets can meet physical demand with promises. It works as long as investors believe alternatives exist. But once supply tightens enough, and once capital realizes miners are the only scalable exposure to silver, the re-rating is not gradual, it's violent. That's why the pressure has to be maintained. That's why the stocks are kept boring. That's why rallies are sold aggressively. Because once the dam breaks, there's no easy way to control the narrative anymore because silver miners don't just reflect price, they magnify truth. When silver moves, miners expose how tight supply really is, how fragile pricing mechanisms are, and how little buffer exists in a system built on leverage. That's why rallies in miners are often capped faster than the metal itself. You'll notice it again and again. Silver pops, miners jump, and within days, selling pressure appears that feels disconnected from fundamentals. That's not coincidence. That's positioning Institutional players understand something retail investors are rarely told. Miners are optionality. They are long-dated call options on a breakdown in confidence. That makes them uncomfortable to own in size. A pension fund can justify owning tech at insane valuations because it fits the growth narrative. It can justify bonds even when yields are negative because they fit the safety narrative. But how do you justify owning a sector that implicitly bets against monetary stability? You don't. So instead of outright bans, you get soft suppression. Low analyst coverage. Con. Conservative price targets, reduced index weighting, capital starvation without headlines. Even when miners deliver strong earnings, the market shrugs. Free cash flow improves, debt is paid down, dividends are initiated, and still the stocks go nowhere. That frustrates investors and drives them out. That's the goal. Weak hands leave first, long-term capital stays away. Eventually, only the most patient or the most informed remain. This thinning of ownership makes the sector easier to control in the short term and far more explosive later. Pay attention to how volatility is treated. Silver miners are labeled volatile to scare conservative investors away, but volatility cuts both ways. What's rarely mentioned is that suppressed volatility eventually snaps. When miners finally move, they don't drift higher, they gap higher. Liquidity disappears, shorts scramble. Funds rush in at once because they're underexposed. That's not theoretical, it's happened every cycle. There's also the issue of hedging. Many miners are criticized for hedging production, but that hedging is often forced by lenders and counterparties. Banks that provide financing want price certainty. That creates artificial selling pressure in futures markets. It caps upside and reinforces the idea that silver can't run. But hedging only works in stable conditions. In a genuine supply squeeze, hedges become liabilities. That's when lenders pull back, credit tightens, and the market suddenly realizes how dependent it was on cheap paper silver. Retail investors often ask why gold miners sometimes outperform while silver miners lag. The answer is leverage and fear. Silver is more volatile, more thinly traded, and more politically sensitive. A rising gold price is tolerable. A rising silver price screams industrial shortages and monetary stress at the same time. That dual role makes silver miners especially inconvenient. They don't fit neatly into a box. They aren't just inflation hedges, they're supply warnings. Watch the behavior around key technical levels. Every time silver approaches a breakout, miners are already rolling over. That conditions investors to expect failure. Eventually, nobody believes in the breakout anymore. That's when the breakout actually happens. Markets love maximum disbelief. Suppression creates that disbelief. It keeps expectations low, so reactions are extreme when reality intrudes. And reality is intruding faster than most realize. Global mine supply has been stagnant. New discoveries are rarer. Permitting takes longer. Capital expenditure has been cut for years. You can't starve an industry of capital indefinitely without consequences. When demand rises, supply can't respond quickly. That's the trap being set. Or maybe already sprung. Tomorrow matters because markets move ahead of headlines. Price action often tells the story before the news does. When silver miners start moving together, not one or two names but the entire sector, that's your signal. That's pressure. Releasing. That's suppression losing its grip. And when that happens, explanations will come later. Analysts will suddenly find reasons. Targets will be raised, narratives will flip. But the move will already be underway and unstoppable because, once trust breaks, markets reprice faster than people can react. Silver miners don't need perfect conditions to run. They need one thing, a shift in perception. The moment investors realize suppression is not weakness but pressure, everything changes. What looked like dead money suddenly looks like coiled energy. And the market has a long history of rewarding those who recognize that shift early. Think about how quickly narratives flip. One quarter, miners are capital-intensive dinosaurs. The next, they're disciplined cash machines with irreplaceable assets. Nothing fundamental changes overnight. What changes is price. And price changes psychology. When silver starts to rise and miners don't get sold back down, confidence returns in waves. Shorts cover first. Then sideline capital steps in. Then momentum funds chase. By the time the average investor notices, valuations are no longer cheap. Another uncomfortable truth is that silver miners represent real things in a digital financial world. Real ore, real labor, real energy, real supply chains. In an era obsessed with financial engineering and paper assets, that tangibility is treated as a flaw, until it becomes the advantage. When inflation proves sticky, when supply chains fracture, when financial promises feel less certain. Suddenly, companies that produce something essential gain respect. Watch the divergence between paper-silver narratives and physical reality. Premiums tell a different story than spot prices. Delivery times matter more than quotes. When those cracks widen, miners become unavoidable. You can suppress a price on a screen. You can't suppress demand forever. At some point, supply has to respond, and the only way it does is through miners. That's when leverage works in their favor instead of against them. The most dangerous moment for suppression is boredom turning into disbelief. That's where we are now. Investors aren't euphoric, they're exhausted, they've given up. That's fertile ground for reversals. Markets don't bottom when everyone is scared, they bottom when nobody cares. Silver miners are deep in that zone. Ignored, under-owned, under-followed, underappreciated. Tomorrow isn't about a single event. It's about watching behavior. Does selling pressure fail to appear? Do miners hold gains? Do correlations break? These are subtle shifts, but they matter. Suppression doesn't end with an announcement. It ends with exhaustion. When the effort to keep prices contained requires more energy than letting them rise, the system chooses the path of least resistance. And when that happens, explanations won't matter. The move won't wait for consensus. It never does. Silver miners will do what they've always done after long periods of neglect. They will move sharply, decisively, and without warning. Those watching closely will recognize it for what it is. Not a fluke, not a meme trade, but the release of pressure that was never meant to be permanent. The takeaway is simple but uncomfortable. Silver miners are not being ignored because they're broken. They're being ignored because they're dangerous to the story markets prefer to tell. Suppression is not proof of failure, it's proof of importance. And when the market finally admits that, the repricing won't ask for permission.